Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. I recently called Beyond Meat one of the stocks that I would avoid, and operating results that we got last week showed just how weak this company is and what a challenge it's going to be to get to any sort of profitability or cash flow positive. So I want to dig into the recent results and show why this is still not a stock I'm interested in buying. My name is Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you like this video, check out my newsletter, Asymmetric Investing, in the show notes. And I want to go to the release because the numbers here are really shocking. You can see that net revenue was down 30.5% in the second quarter of 2023 to $102 million. Gross profit, $2.3 million, or just 2.2% of net revenue. Just an incredibly low number. Management did say there were actually some tailwinds behind gross profit with lower material costs and lower inventory reserves, but that was partially offset by higher manufacturing costs because they're not spreading those sales across a larger sale base, so depreciation costs go up as a result. Net loss in total was $53.5 million, and adjusted EBITDA loss was $40.8 million. The revenue numbers are bad, but right here is a table that shows the volume that Beyond Meat is selling. And I think this is what's really shocking, is that people just simply don't want this product. Retail sales were down 34%. Food service sales down 44%. Remember, food service was supposed to be this big growth market for Beyond Meat. Getting into things like fast food restaurants was supposed to be something, was supposed to expand the product's end market, and that just didn't end up being the case. So the fact that that is declining at that kind of rate is just absolutely shocking. International retail also down 18%, but food service was up 19% in the quarter. Overall, volume of product was down 23.9%. So just heading absolutely in the wrong direction. And the decline is accelerating because in the first half of the year, volume was only down 17.1%. So it's getting worse in the second quarter. If we look at cash from operations, this gives us an idea of how much cash the company is actually burning. $88.3 million in the first 6 months of the year. There was a little bit of capital expenditures of $7.1 million. So ballpark, you're talking about almost a $200 million run rate. So now what does the balance sheet look like? Well, cash and equivalents, $211 million. There is $207 million worth of inventory they could sell, but that's really it on the balance sheet. So there's about a year's worth of runway at the current cash burn rate. And here's the big problem, $1.1 billion worth of convertible notes. So there's also a ton of debt on the balance sheet. This is just putting Beyond Meat in a really, really tough financial position. The reality for Beyond Meat is there isn't a lot of demand for their products. They're not able to sell the product that they do sell at a profit, and they have a really bad balance sheet. That's just a terrible combination for investors. The stock still has a market cap of over $800 million, but this is absolutely one that I would avoid because I don't see any sort of turnaround coming anytime soon. The company is going to need more cash, but with that debt, it's going to make it really hard to raise cash. So the stock could continue falling, and it's just a downward spiral for a company like this. So absolutely a company I would avoid right now from an investment perspective. Doesn't mean the stock is guaranteed to go down, but just way too much risk, I think, right now. But what do you think of Beyond Meat's results? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.